In today's episode, I have two interesting stories. In the first one, we'll talk about the quarterly update of wire and cables industry. And in the second one, I'll talk about what happened in IndiGo in Q2 FY26. Hello everyone and welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and bring you the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. I'm your host, Kashish Kapoor. Today is Tuesday, 11th of November. A few months ago, we broke down how the wires and cable industry, that's WNC, works through its strong Q1 results. That solid streak, it seems, has continued in its latest Q2 results as well. WNC is an industry that we rarely think about, but activity here tells us about what's happening in many other sectors of the economy. More importantly though, India's WNC firms are bracing themselves for a change. They're preparing themselves for new sources of demand while deprioritizing other lines of businesses. At the same time, as we covered before, new blood backed by tons of capital is entering the industry. Change, they say, is the only constant, and that's the story that comes out to us through their Q2 results. So let's dive into the results of Polycab, KEI Industries, RR Kabel and Havells to see how this industry is changing. All four players posted strong growth in Q2, both on an annual and quarterly basis. Polycab, the undistributed industry leader, has continued its impressive show out. At 6,477 crores of revenue, it is up 18% from the same time last year. Its growth in profit after tax was even more impressive, jumping by 56% from last year. With this performance, Polycab has recorded its best ever second quarter and its best first half of any year. In other words, the biggest company in the sector took an even bigger lead in the race. But KEI Industries was no slouch either. Its revenue grew by 19% year-on-year to 2,726 crores, with PAT up by 31% year-on-year. While its PAT margins are lower than that of Polycab, they have improved this quarter. RR Kabel, the relative upstart that went public just 2 years ago, saw its revenue rise 19.5% year-on-year to 2,164 crores, while its profit more than doubled from last year. Its PAT margin, while thinner compared to both KEI and Polycab, has also bounced back. This was also RR Kabel's best first half of any year. Havells, with its broader consumer portfolio, grew modestly at 5.2% to 4,767 crores. But within its portfolio, the wire and cable business in particular grew 12% year-on-year to over 2,000 crores. It is one of their fastest growing segments. For wire and cable alone, their PAT has grown 1.8 times from last year. Remarkably, across the board, margins held steady despite volatility in prices of copper, which is used to make wires and cables. Copper prices had spiked earlier in the year, but companies used various strategies to combat this risk. For instance, here's Polycab talking about it.
Just two questions. One is that you said that you've already taken a price hike in October. Is it possible to say what kind of price hike you have taken?
Sanjay, you can look at the movement of copper and aluminium along with the USD-INR movement in the previous month to this month and take it the average, and perhaps that is the increase that we would have taken.
Okay, so that essentially tells me that you are protecting your margin despite this volatility.
While KEI hedges against this with some extra copper inventory and clauses in their contracts to pass on higher costs. Now, the growth of this industry has many nuances. The biggest of them is that lately, the cable is taking a much bigger share of the space than the wires. If you've read our primer, you know this distinction matters a lot. But we'll recap it again. Wires are used in simple everyday applications like lights and fans. Cables, on the other hand, often mean higher voltage products used for industrial uses and therefore sold mostly to institutions, businesses, and governments. Most importantly though, cables command better profit per unit than wires. This distinction tells us plenty, like what the new sources of demand are or will be in future, how these products are evolving, and even which industries in India are among the fastest growing. Take KEI for instance. Its extra high voltage, that's EHV power cables, performed extremely impressively, jumping 76% year-on-year from 73 crores to 128 crores. They have an EHV order book of 636 crores. The demand is coming from new age renewable energy sector. Think solar and wind farms. And they do not expect renewable energy, which benefits plenty from government subsidies, to slow down anytime soon. If anything, it might go into overdrive. Another new source of demand for KEI has lately been data centers, which obviously requires tons of cables that can transmit data at nothing less than lightning speed. Cabling makes up 8 to 9% of the cost of data center, while KEI fully intends to cash in on this opportunity. Polycab's premium cable business is playing a slightly different game here. They have special purpose cables or SPC division which caters to EVs, defense and railways. The latter two are dominated by government projects. Polycab's SPC line benefits massively from the government ensuring demand for their products. Even Kabel and Havells, which have traditionally been stronger in-house wires, are slowly making pivot towards cables. This shift towards cables is an interesting proxy for how India's economic trajectory is shaping up. Be it new age industries like renewables and data centers or government priority sectors like defense and railways, the whole space of opportunity has opened up for this industry. Moreover, the demand from the bread and butter sectors of the industry like real estate, both residential and commercial, and infrastructure is still going strong. To meet all this demand, companies are increasingly installing new capacity to make them in-house. That's where we begin to talk about the capex plans of this industry. Wire and cable companies are pouring money hand over fist into capacity expansion, much of which is dedicated towards high voltage and specialty cables. They're moving up the value chain to produce more complex and high margin products. Polycab has embarked on a massive 5-year plan to invest anywhere between 6,000 to 8,000 crores in its wire and cable segment. In the first half of this year alone, it spent 750 crores on new factories and technology upgrades for its high voltage cable capabilities. As for how important this capex could be, the management expects it to yield 4 to 5 times the revenue for those particular products once facilities stabilizes. 4 to 5 times. Let that sink in. For context, Polycab made 22,000 crores in revenue last year.
But if you are looking at what incremental revenue potential this capex generates, you can take a 4 to 5% turn on the capex that we are doing, and perhaps with a lag of 1.5 to 2 years, that is the kind of incremental revenue potential this capex will be generating for us.
KEI, while limited in size, is just as aggressive. This year, it has fueled 1,000 crores into its new plant in Gujarat, which is primarily meant for EHV cables. While the completion of the plant is delayed, it's still expected to yield 3,000 crores in additional revenue once first phase is operational. Both Kabel and Havells are less detailed about their plans, but Kabel has planned a capex of 1,200 crores over the next few years, 80% of which is meant for low, medium and high voltage cables. Meanwhile, Havells will be investing 1,450 crores this year alone. While the results of top wire and cable companies have been fantastic, they have also been marked by business lines that didn't grow as much. Within that, 2 trends come out this quarter. First, the sunsetting of EPC business. Earlier, we had mentioned how EPC projects were increasingly making a lower chunk of the wire and cable businesses. In EPC contracts, the amounts tend to be large, but margins are very low. EPC projects can also suffer cost overruns and payment delays. That's why the top players are deliberately deprioritizing it. KEI, for instance, has practically put a cap on it. This quarter, EPC sales fell from 80 crores last year to measly 47 crore, not even making up 2% of their revenue. In fact, an analyst straight up asked them whether they'll quit the EPC business, to which their response was this.
Okay, sir. So, on that lastly, EPC segment side, I think this quarter we have seen significant degrowth. Is there any, we are planning to completely exit this business or want to maintain minimal presence for strategic reasons?
Normally 2-3% is the as per the revenue is coming from EPC. We will be able to, our aim is to maintain 400 to 500 crore sales in EPC segment. That is our goal on a yearly basis.
Meanwhile, Kabel doesn't even have an EPC line, sticking purely to product sales. Polycab, though, has a much stronger EPC segment. Yet, it saw a 19% decline this quarter in EPC revenues, primarily because of project timing. But they have also mentioned before that there isn't much left to pursue in the EPC business. Second big trend is FMEG. Recently, many of the wire and cable companies have diversified into selling fast-moving electrical goods. That's FMEG, like fans, lights, and switches, quickly becoming a fast-growing segment for Polycab and Kabel. However, this quarter, the division has disappointed across the board. Now, that's even true for Havells, which is easily best known among the 4 companies for this division. The culprit behind this was an unusually long monsoon that killed summer sales. Havells reported weak fan and cooler sales from poor summer season. Similarly, Polycab couldn't sell enough fans for the very same reason. However, as the results show, the FMEG business is not big enough for most of these players to dampen their tide. Something in the results that took us by surprise was a surge in exports. Our first question, of course, was how did exports boom like this with such steep tariffs levied against India? Turns out our wire and cable companies have played the export game quite smartly, diversifying where they sell. RR Kabel is an export-heavy business with 27% of its revenue coming from exports. The US makes up 8% of those sales. In August, Finance Chief Rajesh Jain bluntly said, "I will not take any extra hit on my P&L statement just to make the supply to the US. Instead, they have redirected volumes to their biggest markets in Europe and the Middle East, which together make up 75 to 80% of all their exports." KEI export business also did very well this quarter, doubling from last year to an all-time high of 472 crores. Their exports are primarily going to Australia and the Middle East, as well as some presence in Europe and the US. In fact, both RR Kabel and KEI are hopeful that eventually exports to the US will also stabilize and grow. In the first half of FY26, Polycab also saw its export revenue rise 25% to 420 crores. They're diversified across regions, including Europe, Australia, Middle East, and South America. However, US makes up 20% of their exports. Now, Indian wire and cable firms are clearly quite adept at navigating trade disruptions, but additionally, they're also riding new industrial waves taking place internationally. Europe, for instance, is working on upgrading its energy infrastructure to renewables. The Middle East is on a construction spree with multiple mega projects. Even Africa is electrified. Now, what it all means. For wire and cable firms, the second quarter of this year has been unmistakably upbeat. They're hoping to surf multiple waves that are currently in their favor. They're ready to move up the value chain and are investing thousands of crores each year in service of that goal. All the while, they're actively pruning out parts of their business like EPC that carry too much baggage without yielding much returns. They're combining ambition with discipline and they're really doing it well. If their big bets pan out, we could see several more quarters of such electrifying performance from them. And now on to the second story for the day. IndiGo, by far the largest airline in India, recently released its second quarter results. And the results look kind of weird. It delivered a 10% revenue jump, but made a whopping 2,580 crore loss. On paper, this would normally spell disaster, but the reality, of course, is a little different. So let's dive into what IndiGo's result really says. For IndiGo, July-September is usually the soft quarter. This quarter, the rains get heavy, while also having fewer holidays and slower business travel. This year, though, the story flipped. The underlying business was healthy, but a sharp rupee fall turned an operating profit into a reported loss. Now, IndiGo earned 19,600 crores in revenue, 10% more than last year, and actually managed to turn an operational profit of 104 crores. And if there's anything true about the airline business, it's that making bank is really hard. In the same quarter last year, IndiGo recorded a 750 crore loss. So how did a profitable quarter become a headline loss? Well, because of accounting. More precisely, it was the rupee. IndiGo owes $9 billion in future payments for aircraft leases and maintenance contracts. These are dollar obligations spread over several years. Accounting rules require companies to mark to market these liabilities at the end of every quarter. What this means is that whenever rupee weakens against the dollar, the math has to change. The currency fell by 3 rupees and 18 paisa against the dollar between July and September. So all those dollar obligations suddenly looked costlier in rupee terms.
With a 3.18 rupee depreciation at the September quarter end as compared to the June quarter end, we ended up with around 29 billion rupees foreign exchange loss under the foreign exchange line item in the income statement.
Nothing actually moved in cash, but on paper, IndiGo had to recognize a 2,900 crore foreign exchange loss. The CFO explained it very simply. For every 1 rupee that the rupee weakens, wipes out about 900 crore of IndiGo's book. So this quarter, the airline lost money without actually spending rupee more. This is a reminder that in dollar-denominated businesses like aviation, currency swings can decide whether you look like a success or a failure, even when the underlying business is just fine. But what really made this quarter interesting wasn't the forex loss. It was a major shift in how IndiGo did business that was hidden in fine print. IndiGo has lived by one motto: lease everything, own nothing. That's what's kept them nimble and scalable. But that model also left it deeply exposed to the dollar. Every rent check goes abroad, while every rupee of depreciation hits profit. This quarter, like many of the past quarters, management said they're going to change that. By 2030, IndiGo wants to own or finance lease 30 to 40% of its fleet, meaning more planes will sit on its balance sheet as assets and not as rented equipment.
We have historically operated with an operating lease-heavy model. We are now actively transitioning towards a more balanced structure. By 2030, our goal is to have 30 to 40% of our total fleet held on our balance sheet, either in the form of owned or finance lease structured.
Right now, the airline has 417 aircraft, most of them leased from foreign lessors. But a growing number are now being financed through IndiGo's own leasing arm in Gift City, Gujarat's financial hub. That structure lets IndiGo borrow in dollars at lower rates but still keep control, effectively paying rent to itself. It's not full ownership yet, but it's a step away from total dependency on foreign lessors, something we've covered before. The difference is simple here. Under a finance lease, IndiGo gradually pays off the aircraft like an installment plan. At the end of the term, it owns the plane. That locks in a lower long-term cost per aircraft and reduces the sting of currency volatility because more of the financing can be rupee-based. As of September, IndiGo has 14 owned and 62 finance-leased aircraft, compared with virtually none a year ago. It's a small start, but symbolically a huge one. The company that built its fortune on staying asset-light is now willing to take more and more on the balance sheet if it buys them stability later. This shift doesn't stop at ownership though. IndiGo is also spending 1,000 crores to build a maintenance, repair and overhaul facility in Bengaluru. Right now, almost all of IndiGo's heavy maintenance, the deep technical work that keeps the planes airworthy, happens overseas. It's costly and slow, and global MRO capacity has become stretched. Bringing that work home means shorter turnaround times, lower costs and greater control. It also fits the same logic as the fleet strategy. Take more responsibility in-house, depend less on external suppliers and build local capabilities. IndiGo is also making an important addition to its arsenal, which is flying longer. For nearly 2 decades, IndiGo has been the workhorse of Indian skies. Short routes, high frequency and on-time efficiency. It dominated domestic travel and operated in nearby international routes like Dubai, Singapore and Bangkok. But its planes, the Airbus A320s and A321s, simply couldn't fly much further. But now that's changing. This quarter, IndiGo began its first ever long-haul flights to Amsterdam, Manchester, Copenhagen, and London Heathrow using leased Boeing 787 wide-body jets. These are its first twin-aisle aircraft, which are bigger, heavier, and capable of flying twice as far as the narrow bodies that built the company. And this isn't a one-off experiment. The airline has ordered 60 Airbus A350 wide bodies, double its earlier plan of 30, with deliveries starting from 2028. Those planes can fly 12 to 15 hours non-stop routes like Delhi-Tokyo, Mumbai-New York, that no Indian low-cost carrier has ever operated sustainably. In the meantime, before the order arrives, IndiGo will use the Airbus A321 XLR, a new long-range version of its familiar single-aisle workhorse. The XLR can fly up to 8 hours, enough to reach Athens, Istanbul, East Africa or Central Asia non-stop. That bridges the gap between short regional routes and the ultra-long ones that the A350s will eventually handle. This is a huge strategic leap. For years, the company defined itself by discipline. Fly short, fast and cheap. Now it's stepping into the long-haul market crowded with global giants like Emirates, Qatar Airways and the Singapore Airlines who have spent decades perfecting the hub model. And even without the competition, long-haul flying is tough as fuel is a bigger share of cost and crew duty times are much longer. But this leap also opens up something IndiGo never had: cargo capacity and dollar revenue. Right now, more than 90% of India's international cargo, like electronics, pharmaceuticals, textile, and so on, flies on foreign carriers. IndiGo's narrow bodies barely have space for luggage, let alone freight. A Boeing 787 or Airbus A350, on the other hand, can carry several tons of cargo under its passenger deck. Even a small slice of that market gives IndiGo new income in dollars, helping offset the same currency risk that hit profits this quarter. Interestingly, while IndiGo was busy adding flights to London and Amsterdam, its domestic capacity barely moved this quarter. The airline faced multiple constraints: Delhi airport's runway closure for maintenance and delays in new airports like Navi Mumbai and Jewar. Now, the easiest way to see whether the airline's business model is sound is by zooming in on the economics of a single seat. Passenger revenue per kilometer, or yield, rose 3% year on year. Planes were about as full as last year with load factors around 83%. That means pricing held firm despite capacity additions across the industry. On the cost side, fuel costs per seat dropped 16% thanks to lower oil prices and the retirement of older, less efficient leased aircrafts. But non-fuel costs rose about 4%, largely because of rupee depreciation and lower domestic flying hours. When planes fly fewer hours, fixed costs like salaries, leases, and maintenance are spread over fewer kilometers, pushing the unit cost up. IndiGo now expects a low single-digit increase in unit cost for the year, instead of keeping it flat as earlier hoped. It's not alarming, but it shows how much currency and operational hiccups can ripple through even the most efficient airline model. Now, IndiGo is expecting high teens capacity growth in both Q3 and Q4, one of its sharpest quarter-on-quarter jumps ever. Most of that expansion will come internationally as new long-haul routes ramp up and China flights return. Domestically, growth will pick up once delayed airports open. In fact, Q3 has already opened well, helped by an early Diwali and a surge in festival travel in October. IndiGo expects passenger revenue per seat in Q3 to be roughly flat or slightly higher than last year's record high, which, given the heavy capacity additions, is effectively a positive signal for demand. IndiGo is not merely satisfied with being a low-cost carrier. It wants a global network, its own assets, maintenance capabilities, premium cabins, and long-haul reach, all ideally built on the same operational discipline that made it dominant at home. The risk of such an ambitious bet, of course, is that margins don't deliver in long haul, or that exchange rate volatility keeps wrecking profits. But the opportunity is just as massive to capture outbound travel, cargo, and connect India directly to the world. And IndiGo has the balance sheet, the cash, and the scale to try all of it. Finally, on to tidbits for the day. Consumer inflation in India is expected to have fallen to 0.48% in October, the lowest in at least a decade, driven by falling food prices and base effects from the last year. Economists say the decline may be temporary, with risks of supply shocks from unseasonal rain and higher pulse import duties. Next up, Hindalco will invest $750 million in equity and raise debt for its US subsidiary Novelis to manage cash flow after a fire at its Oswego plant and rising cost at its $5 billion Bay Minette project. A second $1.5 billion phase is planned to double the capacity to 1.2 million tons. And finally, food delivery giant Swiggy approved plans to raise up to 10,000 crores via a qualified institutional placement to boost growth and fund new ventures in quick commerce. The firm also sold its Rapido stake for $270 million and slowed warehouse expansion to improve margins. And that's it for today. We'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.